Welcome to Global Market Pulse, your source for insights on the latest market trends, economic developments, and investment strategies. Today, we're diving into the current state of global markets, analyzing key economic indicators, and exploring how to navigate these uncertain times. Whether you're an investor, a trader, or simply interested in the forces driving the economy, this episode is packed with valuable information. Let's start with the volatility we've seen in the markets recently. The S&P 500, Nasdaq, and Dow Jones have experienced significant swings, driven by corporate earnings reports, economic data, and geopolitical events. The Nasdaq Composite has been particularly sensitive to tech sector earnings, with companies like Tesla causing major shifts. Meanwhile, the S&P 500 reacts to broader economic indicators like inflation data and Federal Reserve policies. The Dow Jones has seen rallies followed by sharp sell-offs, reflecting market uncertainty. What's behind this volatility? It's a mix of factors. On one hand, positive earnings reports boost investor confidence. On the other, concerns about inflation and potential central bank interventions could slow economic growth. With uncertainty in the air, many investors are turning to safe haven assets like gold. Gold prices have been on the rise, often surpassing $2,400 per ounce, suggesting that investors are hedging against market downturns or economic shocks. This rise in gold prices reflects a broader sentiment of risk aversion. Even though some investors are optimistic about the stock market, there's a clear concern that things could take a turn for the worse. Whether it's inflation, geopolitical tensions, or underwhelming economic data, these factors are driving investors toward gold to protect their portfolios. Now let's shift to cryptocurrencies. Bitcoin and Ethereum have been on a roller coaster ride, with significant price swings driven by macroeconomic data and market sentiment. For instance, Bitcoin has struggled to stay above $65,000, reacting strongly to U.S. inflation figures and large trades. This volatility in the crypto market is not new, but serves as a reminder of how sensitive these assets are to both internal and external factors. Whether you're a seasoned crypto trader or just curious, it's crucial to remember that cryptocurrencies are highly speculative, with opportunities for profit accompanied by significant risk, especially in the current economic climate. Speaking of the economic environment, the U.S. dollar index, or DXY, has been fluctuating. Its strength or weakness often mirrors investor sentiment on risk and inflation. The dollar tends to gain during risk-off scenarios when investors seek safety. But it's not just about the dollar. The global economy faces several challenges. Headlines point to China's manufacturing slowdown, Germany and Japan grappling with shrinking economies, and ongoing geopolitical tensions that could disrupt global trade. There seems to be cautious optimism in the markets, with indices rallying on positive earnings and economic data. However, this is tempered by significant concerns over inflation, potential central bank rate adjustments, and geopolitical risks. The frequent shifts in market direction suggest that traders are reacting quickly to new data, leading to short-lived rallies and corrections. The rise in gold prices indicates underlying risk aversion, with investors hedging against potential downturns in equity markets or economic shocks. The U.S. dollar's movement also reflects this sentiment, with strength during uncertainty. The cryptocurrency market remains highly volatile, with significant price swings driven by both internal market dynamics and external economic indicators. This suggests a speculative environment where traders are quick to react to news, both positive and negative. Headlines highlighting China's manufacturing slowdown, Eurozone political instability, and Japan's deflationary struggles underscore ongoing global economic uncertainty. These factors contribute to overall market volatility and investor caution. Given the mixed sentiment and volatility across asset classes, a diversified portfolio, including equities, bonds, gold, and possibly cryptocurrencies, could help mitigate risk. Active monitoring of key economic indicators like inflation data, employment figures, and central bank announcements is crucial. Tools like stop-loss orders and hedging strategies can help manage downside risk. In uncertain times, increasing exposure to gold and the U.S. dollar might offer a hedge against market downturns. Additionally, considering defensive sectors or dividend-paying stocks could provide stability. For those with a higher risk tolerance, the volatility in cryptocurrencies and tech stocks, particularly within the Nasdaq, could present trading opportunities, albeit with a need for careful risk management.